Welcome to the What's Your Deal podcast, where we discuss business acquisitions, investments, management, and exit strategies. I'm your host, Matt Uhler. Let's dive in. Welcome back to another episode of What's Your Deal. I'm excited about today's guest because we're going to talk about how so many of us as business owners focus on working hard. We're dealing with the day-to-day. We're working on, and in most cases, in the business, but we're not necessarily planning for what's coming. And I've had quite a few clients that I've helped retire from the business over the years, who then end up running out of money after they sold their most significant asset. We don't want that to be you. Today's conversation is about that. So our guest today is Anthony Perez of Harvest Wealth Strategies. Anthony works with business owners, entrepreneurs, and high net worth individuals to help them navigate one of the biggest financial transitions of their lives, which is turning their business equity into personal wealth. So whether you're preparing to build a company, grow your business, sell your business, or protect your wealth, you've worked for decades to build, Anthony is the guy. So Anthony,
yes,
welcome to What's Your Deal, and thanks for joining us
today.
Glad
to be here.
Yeah, so one of the things I want to dive into, as we were talking about before we started the show, is just this tendency. I've said, and most of my clients don't like it when I say it, but most of my clients are making emotional decisions about selling their business and not financial decisions.
Correct.
And I don't mean that in the sense that it's stop being so emotional. I mean, they're sick of it. They're tired. They don't want to do it anymore. Something's triggered them. And it's one of the most significant financial decisions they make in their lives. And so as you're working with clients all the time who are crossing this transition period, how do people do it successfully and plan accordingly so they can have some comfort around making the decision to sell?
Yeah, no, that's a great question. So as you mentioned, a lot of business owners, their business typically is the largest asset in their estate. And typically it's about 80 to 90% of their personal net worth. So navigating this path, I always say you can't do any redos. So once you sell your business, you sell your business. And so the personal financial planning is so critical. And I call this knowing your number. And so when we talk about knowing your number, it's understanding what it's going to take to maintain your lifestyle, but then also your legacy. A lot of owners will just think about, how do I make sure that I can continue my lifestyle? But they don't necessarily look at the legacy that they're looking to leave behind. The additional is taxes. We all love taxes, right?
Oh, yeah.
And so, just because you're getting a $10 million sale doesn't necessarily mean you're going to have $10 million. So factoring the taxes in as well.
So we could honestly spend our entire hour talking just about that because there's so much built in there. Mm-hmm. So when I'm working with people who are interested in selling, and I know you help people prepare for exit as well, most often it's driven by, I'm done doing what I'm doing. I want to do something else. What's it worth? Get rid of it. Mm-hmm. That's so different than what you just said.
Absolutely.
Which is having enough money and legacy and all those things. So how do you deal with that when you're working with a client? Usually by the time they come to me, frankly, as a broker or a coach, it's already done. I mean, they're past the point where they're going to go back and rebuild. How do you help them get ready for that?
So a lot of it's preparation. So typically I get involved with owners about a year to 2 years prior to actually making the transition. And a lot of it is, number one, understanding how to determine the value of their company. Mm-hmm. A lot of owners think that it's the financial aspects, it's the revenue, it's the profit, when in reality, it's what I call intangible assets. So these are areas such as owner dependency, client concentration, people, processes. So understanding the value of the company is so critical. And then more importantly, how to increase that value of the company. So that preparation flows straight into that, what I mentioned before, which is the number to determine what that needs to look like to fulfill those lifestyle needs. So starting with the value of the company, how to increase it, and then making sure that it's going to fulfill their lifestyle and legacy goals.
So you're literally reverse engineering
Correct.
The exit.
100%.
And when people come to you, are they typically they're already done like they are by the time they come to me? Or are they like, oh, tell me what I need to do. I got another good 10 years in me. Let's do this right. I mean, is that the conversation?
I would love to say that's the case.
Yeah.
But the reality
it sounded good when I said it, didn't it?
I mean, the reality is I usually get the owner that comes to me says, I'm burnt out. I just worked a 12-hour day yesterday. I got people calling in sick. I just don't want to do this anymore. Get me out of this. That's the reality of it. I try to educate business owners that by the time you get to that point, you're severely limiting your options, not only from a personal, but from a business financial standpoint as well. So as much as I would love to say that we're talking 2, 3, 10 years out, the reality is that it's usually within that last year.
Okay. So for the people that are in our audience, lesson number 1, plan early. Right? I mean, it's so worth it. Again, the statistic you shared about the significant percentage of wealth that most people's business is in their life is huge. And if we think about how much time and energy we focus on matters that don't matter, as opposed to matters that do matter, well, 90% of your financial future based on activity now is worth paying attention to.
Absolutely.
So why don't more people do it?
I think it's natural. Most business owners are in their business, right? So we talk about working in the business as opposed to on the business. There's a big difference between the two. Most business owners are unfortunately in the business. So they're day-to-day, 100%, go all the time. The last thing they're thinking about is what type of planning am I doing to exit my business and take care of me personally. So that's one of the biggest reasons I see. And I'll step back one other to the question that you made earlier. So another area that I see business owners miss a lot is moving money from the business to themselves personally. And this is a very easy strategy that they can take. There are a number of different advantages that business owners have to start moving money from the business to things like retirement accounts that give a significant advantage not only to the business, but also to them personally. So there are tactics that they can be taking even now to get them prepared for that. But to go back to answer your question, it's a lot of times is because they're working in the business and they just don't have the time to think about this.
So it's like you can't see beyond the walls,
Exactly.
right? It's just the walls are too high.
Absolutely, 100%.
Yeah, well, and the piece that you bring up that I've had the benefit of literally seeing hundreds and thousands of people run their business various ways. What you said about taking money from your business, most people think, yeah, I'm going to go buy a boat. I'm going to go buy an RV. I just bought myself a toy to try to make myself feel better about the work I do. That's not what you're talking about.
No, not at all. Not at all.
Yes.
So it's interesting. When I look at business owners, you have your lifestyle owners and you have your wealth creator owners.
I like that.
And when I have this conversation, I'll give you an example. So I had 2 clients, one in Orange County, which for those of you that are familiar with Orange County, it's typically, let me show you how rich I am. So I'm going to drive the nicest car. I'm going to have the biggest house. So one of my clients, $25 million company, did extremely well, had the nicest house, had the nicest car, basically spent pretty much all of the profits from the company, right? My other client that I had here in Phoenix lived very well within his means, had a company that was only doing $5 million in revenue. But because of his living expenses, he was able to accumulate a pretty decent amount of wealth. Plus, he was moving money to his personal, which we talked about. At the end of the day, when you look at the 2 owners, if something were to happen to their businesses, my client in Orange County would have no wealth whatsoever. My client here in Phoenix would have a decent amount of wealth. So that's the difference between what you mentioned, which is lifestyle, and then also truly creating generational wealth.
Yeah, it does take discipline to build generational wealth, but it's because of my role as a broker, I get the calls from people who, my wife's got cancer, I just got to be done. Or I've got cancer, I've just got to be done. Or something that shows up in life that says the game's coming to an end. And it could just be my parents, I need to move somewhere. I mean, whatever it is. But if every penny gets spent on lifestyle, or if every penny from a business is not invested for the future, then we have the potential as business owners of risking the freedom that we appreciate so much.
That's right.
To do what we want when we want, as long as we're getting the job done, right? And I know that might sound, some people might have resistance with the idea of being
Sure.
self-employed and doing whatever you want, whenever you want. But we get to call the shots.
That's right.
And allocate our time the way we choose. That can change, especially if you run out of money at some point in the process.
Correct.
So then, how do you work with people like as an example, the gentleman in Orange County and the gentleman in Phoenix? How are you motivating them to change their way of being to help them have the life they're wanting?
Sure.
Seeking.
Yeah. So as I mentioned, it starts with understanding the value of the company and how it fits into their personal financial situation. So using the example of my client here in Phoenix, which is the most recent case, we took the valuation of the company, we built it into a personal financial plan to understand, again, what would that accomplish as it relates to hitting his lifestyle and legacy goals. From there, we looked at what were some of the key drivers in the business that could increase the value of the company. Because in this case, the current value of the company was great, but it wasn't necessarily going to be enough to hit his personal goals. So we looked at what levers can we pull within the business to get him to his number, which was the number after tax that he would need to sell his company for. So that was the process that we've taken him through. And right now he's in a very good position. The other thing I'll mention, and you've seen this on your end, is that it also gives them more negotiating power. So when they know that when they're negotiating with a potential buyer, that their number is, they know that inside and out, it allows them to be gives them more leverage in the negotiation of the actual deal.
Okay. So there's a couple things I want to drill into there. One is that the exit provides a certain amount of money,
Correct.
which the client you're referring to was calculating carefully. Like, okay, the sale is going to provide this. But you're also building up other investments for them so that they have revenue coming in, income to their family. So they're less dependent on the business.
Correct.
Right? Because it's a twofold thing, right? I don't see many of my clients that actually sell their business and have enough after-tax dollars to invest it to replicate the lifestyle they were accustomed to when running the business.
Correct.
And that's the rub.
Yeah.
Yeah. So that's what you were working with your client in Phoenix
Correct.
with, is balancing the two.
Absolutely. So it's understanding, again, going back to what I mentioned earlier, that recognizing 80 to 90% of the net worth is in the business. So how do we bring that down? How do we look at diversifying the income streams that you're getting outside of the business so that when it comes time to exit, you sell the business, you have multiple income streams coming in, and you're able to replace that income? Because a lot of business owners don't think about that too, is that once you exit your business, that paycheck stops, right? So you have to figure out, okay, how are you going to replace that income?
Yeah. And so the income piece is part of your process, helping people understand what their true income is from the business?
Correct.
Because I know in my office, that can take months for us to sort through all the different creative ways that people decide to extract money from their business. So many of them are shocked when they realize how much it actually is that they consume, because it's just coming from all these little different buckets and going all these different directions. It can be a lot bigger number than people think.
Oh, 100%. And then as business owners, like you mentioned, you get a little creative in terms of what's considered a business expense compared to a personal expense. So when you pull out all those numbers, it can look very different than what they think it looks like.
So when you're working with a client on exit planning and really planning the exit's part of it, but you're talking when you get into legacy and all of that, I mean, it's really long-term planning financially. How long does that take? I mean, do you recommend people come see you 2 years before sale, 5, 6 months? I know it's not 6 months, but I wanted to throw one out.
Oh, yeah. Yeah, no, I mean, the earlier, or I should say the more time, the better, right? So I would say at least 2 years out. But when I talk to business owners, I mean, when you get into business, you should already start thinking about your exit, right? Start to plan and start to think about what that's going to look like. As far as actually coming in, breaking down the numbers and doing the planning, I'd say about 2 years out is the minimum amount for a couple of different reasons. Number one is we talked about taxes, where there are certain strategies that you can take depending upon what your goals and objectives are to actually minimize and in some cases actually eliminate taxes, when you go to exit the business. In addition to that, it gives you enough time to influence the areas that maybe you may not see that are blind spots that a buyer certainly will see. So again, every business owner thinks their business is the most beautiful baby in the world. But the reality is that a buyer is going to look to pick that thing apart, and they're going to look at all the different blind spots that an owner may have. So giving yourself that couple years in advance allows you to identify those blind spots and then, make improvements in those areas.
It's funny you say that and referring to them as blind spots. I had a buyer-seller meeting a couple weeks ago, and the seller, one of the first things that they did, and you'll appreciate this, one of the first things that they did after a very nice introduction and great people on all sides is they sat down with a piece of paper and listed all of the ways they contribute to the day-to-day operations. And it wasn't 5 hours a week. It was on and on and on. And honestly, I was surprised that the prospective buyer didn't just leave. Okay, I can't fill those shoes. So congratulations and good luck with your next buyer. This buyer decided to stay and continue the conversation because he's sophisticated enough to try to work his way around that. But you mentioned earlier about owner dependency. And the blind spot for this buyer, and I'm not saying he shouldn't share it, but he was proud of it. And literally, and it wouldn't have shocked me at all if it killed the deal. Now, it doesn't mean you just change it or you don't share it, but you change it over time.
Sure. So
that the business is less dependent. And I would think that's a huge part of what you're helping people see through some of those blind spots.
100%. So owner dependency is probably the number one deal killer. I'm sure, as you've seen, it's also the number one way to decrease the value of your company. And it's kind of a catch-22 because owners do take a lot of pride in it. They started the company, they grew it. And a lot of times they're, hey, all the clients deal with me directly. I'm the one that they do business with, not the actual company. So that's one of the first questions I ask is, are your clients doing business with you or are they doing business with your company? Because if they're doing business with you, at some point you're going to need to transition out. The buyer is going to look at that and say, okay, is there a risk that we may lose clients because the owner is no longer here? I actually run through an exercise with owners where we do an owner dependency score. And so it's a lot of the same questions you asked, where we actually run down, we ask a bunch of questions to find out how involved they are in sales, operations, the hiring, the HR, administration. And as you mentioned, some of them will take a lot of pride in it. They're just like, oh, I'm involved in everything. And it's like, that's great. But that, as a buyer, is not so great. And so we walk through that exercise with them. And as I mentioned, that's the 2 years out portion, right? So within 2 years, we can identify those areas and start to build bench strength, right? For key positions within the company. We can start building out processes. There's different aspects of the business that we can start improving to reduce the owner dependency. So,
well, and one of the things I believe is that when the owner dependency gets diluted, then oftentimes they don't need to sell anymore.
Correct.
Or have the desire to anymore because it's not the same burden. So you had mentioned that the owner dependency can decrease value. Can you walk our audience through the various ways that can show up in a transaction?
Sure. Yeah. So I'll give you another example. It's another client that I'm working with right now. He had the relationship. So we talk about relationships. And it's an unfortunate situation. We were getting ready to actually close the deal and he passed away.
Oh, wow.
This deal went from a initial offer of $7 million, $5 million at cash at close, to all the way down to a $2.2 million offer with only $250,000 at close.
Because of his passing?
Because of his passing, but in the eyes of the buyer, they felt that it was owner dependency. So in their eyes, the relationships they felt were with him, and now that he has passed, they felt that the significant chunk of that revenue was going to leave. And not only that, buyers, they don't buy necessarily revenue, they buy certainty. And when you have something like that happen, there's a lot of uncertainty. And so in this situation, it's unfortunate. We're still working through some of the issues to be able to show the buyer that, maybe it wasn't as owner dependent as they thought. But nonetheless, it's an unfortunate situation where, that has a significant impact. In this case, it's a real live example.
Well, and it's a conversation none of us want to have, but the reality is if that happens, again, that's a significant asset, could be gone. And it sounds like that it's still together. But I've also seen where, because of owner dependency, the buyers are just like, yeah, I mean, who's going to train us? Who's going to familiarize us, introduce us to customers? So it's hard to calculate what the damage control would need to be for a prospective buyer. And I don't blame them, especially if it's so tightly wrapped around the seller.
Yep, 100%.
Yeah.
100%.
What other ways, or maybe we can go back and forth a little bit because I've got some too, but what other ways do you see that owner dependency decreases value?
Sure. So when we look at owner dependency, as I mentioned, you have the relationships, you also have the processes piece. And so when you look at owner dependency, as I mentioned before, if they're the ones doing the operations, if they're the ones doing the hiring, the firing, all of those related functions need an actual person that should be taking on those responsibilities. So, for example, if we look at employee, acquisition and retention, right? If they're the ones that are spending all this time going out and interviewing people, and then they're the ones that have to put them on performance plans, or eventually maybe potentially have to let them go, not only is that time that they're taking away from doing what they do best, which is, running the business, but it's also something that can be fillable by actually hiring somebody that can come in and take that off their shoulders. Not only free up more time, but probably do it a lot more effectively than them. So that's just one example of how, if that is not in place, once again, the buyer starts to question the people aspect of it to say, not only is there a risk that the owner leaves, but do I have the right people in place that are going to be able to step into these roles? So that kind of hits from both ends.
Yeah, it sure does. And from a valuation perspective, I'm working on a transaction right now where the prospective buyer, is estimating what it's going to cost them to replace the seller. And that usually buyers will estimate high, right? And that therefore comes right off of EBITDA or discretionary earnings or some calculation, which has a multiplied impact on the value of the business. And it's just, all things point to proper preparation in this area.
Correct.
Really worth doing.
Oh yeah, absolutely, 100%. You also mentioned a key word is multiplier, right? So I love having conversations with owners and, asking that question is, do you understand the value of the company, right? And the first answer is, well, yeah, I look at revenue, profit, and I heard of something called a multiplier. And I say, well, do you understand how the multiplier works? And it's like, well, no, I talked to my fellow business owner. He told me he got a multiple of 5. And so I'm kind of assuming that that's where I'm at. And so when we talk about the multiplier, well, it's determined by those factors you just mentioned, right? So owner dependency is a part of it. In most industries, you could have a multiplier that can range anywhere from like a 4 to an 8. Right. Well, if you're 100% owner dependent, you're going to be on that 4 side, right? So when you talk about, how to determine, you had your buyer that's trying to figure out and discount the actual value. That's the math that they're doing to determine, what should I be taking away from the value? And that usually comes in the way of the multiplier.
Yeah, it sure does. And the impact is compounded.
Absolutely.
And so it's the idea of designing your business so that it's ready to be sold so people don't start hacking away at it is really valuable, especially if you're looking at generational wealth. And we'll think just for a moment about a home, right? It's like you're going to sell your home, and I don't want to fix it up. I'm not going to paint it. I'm not going to do any of this stuff. Well, the buyer comes in, they're going to say, well, it needs paint. So let's just say it's going to be $15,000. And they just start coming up with numbers. I've seen the same thing happen in businesses, but this multiplier, let's talk about that for a second. So businesses generally sell for a multiple of discretionary earnings or EBITDA.
Correct.
And where they fall on that level has to do with artistic aspects, right? Operational, owner dependency, customer saturation, all of these things. And that's what I've seen. It gets so dangerous where people get hung up on, well, it's a 5 or it's a 4. My friend said it's a 4, it's a 4. My accountant said it's a 3, it's a 3. It just isn't. There's so much more that goes into it, and you walk people through that. So do you find a whole lot of resistance with people on a multiple they have in their head, or you're able to convey to them, here's the value and why, and they hear you, and then you move on from there?
No, so it's a great question, and yes and no. So there are some owners that are just stuck on a multiple. That's kind of like, well, my company is just as good as my buddy's company, and he got this multiple. In fact, I think my company's better than his, so I should be getting a higher multiple. And then there are those owners that, they want the education. They want to understand how this works. Those are the ones that I love working with, because when you do kind of break down and you look at those intangible assets that I discussed before, it helps them start to kind of think in terms of, so that can add to my multiplier, right? So we talked about if I do hire better people, maybe my multiple goes up from a 4 to a 5, right? Now, if I, implement SOP, standard operating procedures, I upgrade my technology, which I haven't done in 15 years, right? Maybe that moves my multiple up to a 6. So all these different aspects, and like you said, it's an art form, right? It's not the number crunching portion. The number crunching portion is the EBITDA, right? That's the quantitative piece. The multiple is really qualitative.
And so do you help people, you clearly help people grow their wealth outside their business, but I think you referred to a little bit how you can help them to build value within the business as well. So that's a coaching dynamic regarding some of these intangible aspects?
100%. So I'm a big believer in integrating both. So I see a lot of individuals in my space that either focus on one or the other. Very few actually focus on both. So either they'll come in as like a business consultant and they'll kind of talk through, okay, these are the different ways that you can improve the actual operational aspect of the business. And then you have your traditional wealth management teams that will go in and do the personal financial planning. They'll help them understand kind of what we talked about, the cash flow, the retirement planning, investments. I do both. So I think it's important to integrate, both the business and the personal aspect of it, because again, the largest asset usually is the business. And so when we look at that personal financial planning, that influences it. So if I can help a business owner go from their company being worth $8 million today to $10 million, right, through some of the things that we just talked about, that has a significant impact on their personal financial plan, right? So I think it's important to integrate, both as part of that process.
Well, and what I love about that I think is worth us pointing out is that more often than not, and tell me if I'm wrong, because it's your world in the financial planning standpoint, but I would venture to guess that for most business owners, they can build wealth way quicker in their own business than they can trying to invest in somebody else's business. Is that safe to say?
100%. In fact, I just had a conversation with an owner actually 2 days ago where he's very, very suspect about investments, general investment management. And his comment to me was very simply put, I only trust investing in myself and my business. I don't trust the stock market because unless I can see their books and I can understand their financials, I don't know that I feel comfortable with that. And so I said, well, so if you're looking at the S&P 500, there's 500 different financial statements you'd have to go through. So, I mean, that's up to you. But there is a lot of business owners, they feel confident in themselves and as they should and in their business.
So what I love so much about that conversation is I see a lot of business owners that want to do exactly what you just said. They want to continue to invest in their business. And I think there's huge growth there, but that can be a trap, right?
100%. So, again, as the business is usually the most popular investment for business owners, it's important to start diversifying some of those assets out. Like you mentioned, I mean, when you look at different time periods that we've gone through, like COVID, where certain businesses had to be shut down, that shuts off a huge revenue stream and in some cases an income stream for the business owner. And so by having those assets outside of the business and having them more diversified just allows them to spread out their risk over multiple different ways to manage their money and not just keeping it all in one asset.
Yeah, so that would be similar, I'm assuming, to you might have a stock that's great one year and one that's not so great. It doesn't mean that you don't continue to put money into smart investments, right? And they all, as opposed to just sticking with the one that you run every day. I can definitely see how that lack of diversification could be a huge, huge trap. And you mentioned a few times legacy. Walk me through what you mean by legacy and how you help people focus on that and really work towards it.
Yeah, so I think, most business owners start their businesses for two reasons, right? One is choices, it's autonomy, right? It's like, I don't want to answer to anybody. I want to kind of have my own business. The other piece of it is that they want to take care of their family and build a legacy. And as they start getting down to the path where they're looking to transition out, it's not just about the money. It's about taking care of their employees. It's about taking care of their family. What I find is a lot of owners are philanthropic. So there are certain causes and organizations that they support. And so as we start to think through what that transition looks like, the legacy piece is just as important. And what I found is in some cases more important to the owner than the actual lifestyle. What they want to know is that they've left it's not about what they left to their family, but it's about what they left in their family. It's their core values. It's, I always ask the question if, looking forward, 10 years from now, what's the number one thing you want your family to remember you by? And so that usually stumps them a little bit because they haven't really thought through that conversation. And so that legacy piece is, I would argue, just as important, if not more important than the lifestyle, because ultimately, as I mentioned, they build the business to leave that legacy. And so kind of helping walk them through what that looks like, I know is a very powerful conversation that they actually enjoy having, so I think that's important.
Yeah, it brings up a couple thoughts for me. One is that so many of the business owners I know, they are so focused on today, right now, and what they have to deal with, that the conversation about legacy, I'm assuming, would bring them into a whole nother time frame, right? It's just a different conversation altogether. And then do you see that this creates a purpose that helps them to close one chapter, as an example?
Yeah, 100%. So I think they get to a point, and as you look at different ways to exit your business, right? There's multiple different ways you can do it, but probably two of the more meaningful ways to leave that legacy is to either sell it to your employees or pass it down to the next generation. So that's usually what starts to kind of, stimulate that thought process of what does that look like? Do I want to sell to a third party just so that I can get the largest amount of money? Or do I want to transition this to the employees that have been with me day one, right? That will continue to carry the torch. Same thing for the family. Is this something I want to stay in the family for generations to come? So that legacy component is such an important part of that discussion when it comes to what the exit or what the transition looks like, so that it's not just about numbers. It's about thinking through what's the why, what's important to them.
I'm hearing it as you're saying it, and I get this sense that it just also gives them the choice. Some of the clients that I've worked with who haven't done what you are describing and help people do, they either can or they can't. If the number drops below a certain number, they can't sell. They're in it for another lap or two to get to the financial position where they think they can, as opposed to the calmness that I hear about what you're describing, where somebody's going, it's time to move on. And I've set this up for my family, and here's what this going to mean for my employees. I mean, that's a whole different conversation from can or can't I. Is that most often financial in the people that you see come to you, that either they can because they've planned accordingly or they can't because they have not planned accordingly?
100%. So obviously it starts with the number, right? Like you mentioned, it's either a yes or no. Either I have the, amount of money that's going to be able to fulfill my goals, or I don't. And obviously if it's no, then we got to start planning to see, okay, how do we get you to that point? If the answer is yes, and I always say, business owners build businesses, and eventually exit, not necessarily for numbers, but for choices. They want to have choices. They want to be able to determine what that looks like. And so the financial component definitely makes a big difference, but then it's also what additional choices do they have, and giving them that flexibility to make whatever the right choice is for them.
Yeah. Well, we all want to have choice, don't we?
Oh, yeah.
Yeah. Yep. I'm working with a client right now that's the exception to the rule, where because of some dynamics in the deal, we're looking at a swing in the price of about $1 million. And for them, it is a choice because it is not their only source of income. It's not their only asset. And literally the husband and wife are trying to determine, is this the quality of life decision they want to make, as opposed to can they or can't they? It's such a different conversation.
Very different conversation. And I'll go back to what I mentioned earlier, right? Is it gives you the leverage. It gives you the negotiating power, because if you know what your number is, and it sounds like your client does, they know exactly what they need. And maybe this asset isn't something where they need to get maximum value out of. Maybe it's more important to them that it's more of a timing thing. Maybe they just want to get out of it. And if, maybe they get a little bit less for the business, they're okay with that. And so it goes back to, you said, I mean, it feels, it's a much better position to be in, knowing that you have that flexibility than knowing that you have to fight for every dollar just so that you can be able to do that.
Yeah, I can feel it as we're talking about it. I hope the people in our audience who are faced with this decision really get the significant decision it is to go, or the significant experience it is to go through this process from a standpoint of, well, do we want to keep doing this or don't we? Not, we just have to, because they won't offer what we want. It's night and day. So somebody wants to start going down this road. What do they do first?
So the first thing I would say is plan. I think we talked about it. The way I look at it is, if you were to get that magic call today, would your business and would you be prepared to transition? Right?
Because that's happening more and more all the time.
It's happening more and more. You're getting
That's a great point.
There's very few owners that I come across that haven't got at least 5 or 6 calls about selling their business. And most of them, they're like, I'm fine. My business is running fine. And I said, well, but what if you were ready, right? I mean, do you have all of your ducks in a row to make that happen? Or would you be scrambling? So I would say plan, right? Take an opportunity, really start to think about what that exit looks like. You don't necessarily have to go through the numbers today, but just start to think about what is the right path you want to take. Like I mentioned, there's really 4 different ways to exit a business, right? 1 is to pass it down to family, right? Number 2 is to sell to your key employees. Number 3 is to sell, right? Engage someone like yourself to take it to market. And then the 4th is just to close the doors. Now, hopefully people don't have to go to the 4th option, but start to just think about what that looks like, what path is going to be the best for you. And then again, understand how the value of your company, how is it determined, and eventually what your number is going to be.
Great. Wow. Again, there's an aspect of this that's not an instant gratification, but it is so worth it. I mean, most of us want to, enjoy our retirement in a way that we get to do what we want to, and to have that cut short because of a lack of financial planning is truly a shame. And the handful of people that I've seen sell their business and end up coming up short, it's painful. It's not I'll just go get a job at Home Depot or wherever else they might want to work. It's not what they want to be doing. They've been used to being self-employed for a long, long time.
That's right.
And how do people find you? If they're ready to stick their toe in the water and start making these decisions, how do they find you?
Yeah, sure. So probably the best way is you can contact me directly. My number is 619-241 6336. You can also find us on all the social media channels, Harvest Wealth Strategies, and then, of course, on our website as well.
Okay, excellent. So I love to finish my podcast with bringing it back to gratitude. And for me, that brings us back to our roots about how we got where we are. And I'd love it if you could share a story of somebody who gave you a hand up or believed in you when you didn't believe in yourself, that helped you move up the ladder one more rung or several.
Yeah, it's interesting. It's a great question. I mean, there's definitely been a lot of people throughout my life that have been there to support me. There's one in particular that comes to mind. So quick little background on myself. So I was in corporate America for 25 years.
Okay.
I held several senior leadership roles within banks, was in the private bank wealth management group. About a year and a half or 2 ago, I actually took the leap and bet on myself. And 6 months into it, I was like, I don't know, what did I do? I actually started looking for jobs back in banking. I'm like, oh, this is crazy. And my mentor, who's been with me, since I was in my early 20s, I remember him calling me up and was like, why are you applying? He's like, you can do this. He's like, you've been successful at every single thing that you've done. Why would this be any different? And I'll never forget that phone call. And he's been there for me, like I said, throughout my career, but most importantly, throughout this process of me kind of taking my own journey and, building the business.
Isn't it something how one conversation can you had a left or a right to take in that time, right? And he guided you to the one that sounds like it serves you well and serves others well.
Yes.
Yeah.
100%.
Oh, that's great. Yeah. Those conversations are really something that I appreciate, because it's amazing to hear, so often we see people, it's easy to judge somebody else's 20th chapter of their story and compare it to our first chapter. And it's great to hear stories about how we all got a hand up on occasion. So
Yeah, absolutely.
Well, thank you so much for joining us and also bringing some insight into how people can make these significant financial decisions a little more strategically and serve them long-term and their family and beyond.
Yeah. Well, glad to be here. And again, appreciate the time.
Absolutely.
All right.
Well, I hope you enjoyed this episode. You know, it's so easy for us to focus on the matters at hand or the things that are burning the hottest, but this conversation is truly one that's worth putting your focus into so that you finish the way you intended and not under circumstances that don't serve you and your family long term. We'll see you on the next episode. And that's a wrap on today's episode. We hope you enjoyed the conversation and got some valuable insights into the world of buying and selling businesses. Want to be a guest on our show? If you have a deal that you'd like to discuss with us or a business story to share, we'd love to hear from you. Shoot us an email using the contact information below in the episode notes, and let's make this happen. Never miss an episode. Make sure you subscribe on Apple Podcasts, Spotify, or wherever you listen. And if you found today's episode helpful, please leave us a review. It helps more people like you find the show.